In 2025, the two biggest oilfield service companies on Earth both saw revenue fall, SLB down 2%, Halliburton down 3%, and yet both returned more cash to shareholders than in any year in their history. SLB handed back $4 billion, up 23%. Halliburton returned 85% of its free cash flow, and of the 6 U.S.-listed giants in this industry, only one grew at all, TechnipFMC up 9%. And it doesn't drill shale. It builds robots on the ocean floor. The map of where oil money flows just got completely redrawn. Let's follow it. For a century, oilfield services was the most violent cycle in energy. Oil booms, drillers spend like crazy, service companies build capacity, then oil crashes and everyone goes bankrupt. 2014 to 2016 wiped out hundreds of them. This time is different. Since 2022, oil and gas producers have sent 45% of their cash flow to dividends and buybacks instead of new drilling. That discipline flows straight downhill. Service companies stopped chasing rig count and started maximizing cash per dollar of revenue. The result, a sector that can shrink on the top line and still pay you more. That's the single most important shift in this industry, and most investors haven't updated their mental model. Now, the split that defines everything. There are two oil businesses, and they're moving in opposite directions. The first is short cycle, U.S. shale. Drill a well, get oil in 90 days, decline fast. It's sensitive to every wiggle in the oil price. And right now, oil is soft. Brent around $77, West Texas near 72, after a brief spike to 101 on Middle East war fears, collapsed in weeks. At those prices, U.S. shale is contracting. The rig count has been stuck in the 560s, North America lost rigs 8 weeks straight, and producers are guiding capex down. The whole short-cycle world is in a holding pattern. The second business is long cycle, offshore and deepwater. Projects that take years to sanction and pump for decades. And here the money is flooding in. Offshore final investment decisions are forecast to jump from roughly $70 billion in 2025 to $107 billion in 2026. Total offshore spending pushes past $300 billion. And here's the fact that breaks the old narrative. A barrel of oil from the deep ocean now breaks even around $43, below U.S. shale's $45. And the gap is widening. The thing everyone calls expensive offshore oil is quietly outcompeting the Permian. Standardization did that, which is exactly why the Subsea players are winning. Let's put the field on the board. 6 U.S.-listed names run global oilfield services. SLB, the $82 billion global number one, three-quarters international. Halliburton, the North American completions leader. Baker Hughes, the one that escaped oil entirely into gas turbines. And LNG. NOV, the drilling equipment maker. TechnipFMC, the Subsea champion riding the deepwater wave. And Weatherford, the post-bankruptcy turnaround, now feeling the land slow down. If you're following this series on the unglamorous machines behind the energy and AI booms, subscribe. Next up, the gold miners minting record margins as bullion hits all-time highs. Same depth. Start with the leader, SLB, formerly Schlumberger. $35.7 billion in revenue, with 78% coming from outside North America. That international weighting is its shield against U.S. shale weakness. Even on a down year, adjusted EBITDA margin held near 24%. But the smart move is what it's becoming. In July 2025, it closed the $7.8 billion acquisition of ChampionX, production chemicals and artificial lift, the sticky, recurring revenue that doesn't swing with the rig count. And its digital platform, Lumi, just crossed $1 billion in annual recurring revenue at 35% margins. SLB is turning a drilling business into a software and services annuity. Halliburton is the mirror image. The North America completions and pressure pumping leader, $22 billion in revenue, roughly 40% North American, which is both its strength and its problem right now. Because that's exactly the market that's soft. Management calls 2026 a transitional year, second half stronger than the first. But watch the cash. Halliburton returned 85% of its free cash flow to shareholders last year, $1 billion in buybacks on top of the dividend. This is the discipline story in one number. a company in a soft patch of its core market, still handing back almost every dollar it earns rather than drilling it into the ground. Now the most interesting name, because it barely competes with the other five anymore. Baker Hughes split itself in two. Its oilfield segment did $14 billion, but its other half, industrial and energy technology, did over $13 billion, growing 10%. And it makes the gas turbines and compressors that liquefy LNG and power data centers. Its real rivals there are Siemens Energy and GE Vernova, not oil services. That segment's backlog hit a record $33 billion. Here's why it matters. U.S. gas production just hit an all-time record of 118 billion cubic feet a day, and 101 gigawatts of on-site gas generation has been announced to power AI data centers. The unglamorous backbone of the AI boom is a gas turbine, and Baker Hughes builds it. The stock is up 42% this year. Remember, only one of the six grew. This is it. TechnipFMC does Subsea, the trees, pumps, and pipelines on the ocean floor. Revenue up 9%, EBITDA up 33%, and a record $16.6 billion backlog. Its edge is a model called Integrated EPCI. It bundles the entire Subsea project into one contract, so over 80% of its awards come with no competitive bidding at all. And its Subsea 2.0 platform uses about 50% fewer parts than legacy gear. That's the standardization that pushed deepwater break-evens below shale. When ExxonMobil itself filed an antitrust complaint to block a rival Subsea merger, you knew the pricing power in this corner of oil had become very, very real. Two more names round out the board, and together they tell the whole cycle. NOV makes the heavy iron, blowout preventers, top drives, the equipment on every rig, $8.7 billion in revenue, a $4 billion backlog, and a catalyst in up to 10 floating production vessel decisions expected in 2026. It's a pure bet on the offshore build-out. Then Weatherford, the cautionary counterpoint. It emerged from bankruptcy in 2019, wiped out nearly $6 billion in debt, and ran margins up to a 15-year high. But it's land and production focused, so 2025 hit it hard. Revenue down 11%. Same industry, opposite end of the split. The post-bankruptcy success now feeling the onshore slowdown. Now the honest column, because this is still oil, and oil is never safe. First, the price. At $70-some with OPEC plus unwinding its cuts and a glut feared into 2027, any further drop hits short-cycle spending first and hardest. Second, geography. North America could stay weak well into 2026, pressuring Halliburton and Weatherford. Third, the Middle East. Both a demand anchor with Saudi Aramco and ADNOC spending over $100 billion a year, and a risk since conflict there shaved real earnings this year. So the debate isn't whether oil services makes money. It's which half of the industry you own, the soft short cycle or the booming long cycle. They are not the same trade. Where does this go over the next 1 to 2 years? Base case, flat to modest revenue growth, with offshore and international offsetting North American weakness, and cash returns staying at record levels. Probable, not guaranteed. 3 things to track. 1. The offshore final investment decision count. Watch whether 2026 delivers that jump toward $107 billion, and whether the floating production decisions land. 2. The North America frac spread count. It troughed at 145 and recovered to 192. If it keeps climbing, short cycle is bottoming. 3. Baker Hughes industrial and energy technology orders. The read on whether LNG and AI gas demand is real money or hype. Catalysts up, a deepwater sanctioning wave, an LNG build-out, AI gas demand, and continued buybacks. Catalysts down, an oil price slide below 60, an OPEC plus glut, or a recession that defers projects. Upstream sit the national oil companies writing the checks. Downstream sits every barrel and every molecule of gas the world burns. The service companies in the middle take their cut either way. The headline says oil services had a down year. The cash flow says it never made more money for its owners. That gap, falling revenue, rising payouts, deepwater beating shale, is the whole story of an industry that finally learned discipline, owned the right half of it, and a boring, shrinking business quietly compounds. I'm Big Z. Follow me. See you in the next deep dive.